As interest rates go down, bond prices rise, and as interest rates go up, correspondingly, bond prices decline. So I've given you a quick example on 247. Turn to 247 if you could. Look at the page there. We assume now, in this example, I'm looking at a bond that pays $65 twice a year, which really means that at the end of the day, it's a 13% bond, right? Because bonds trade at a par of 1,000. They're issued at 1,000 most generally. It's paying $130 a year, so it's 13%. And then interest rates in this market go down to 5% semi-annually or 10% annually. So notice the bond price in the column there that's got the box around it swells to $1,096. Interest rates down in the market, bond prices up. Forget the math. I've given you the math. The math doesn't matter. Think about it this way. If Coke issues 13% bonds, paying 13%, and then interest rates go down to 10% for Coke, would you rather own a 13 or a 10 for the same company? Not a trick question, right? So the market's smart. It knows that the value of that 13, that bond that yields 13, is much higher than it used to be. And so the value of the bond trades up. In fact, the market's so good that if I buy that bond, I would pay $1,096 for it, and the yield would effectively be 10%. Okay? So the only person that would really make money is the original owner of the bond. They'd be able to sell it at a premium of $96. If interest rates go down even further to 8%, you see the price of the bond goes to $1,168. And conversely, if they go up to 14%, I'd rather have a 14 than a 13% bond, then the value of the bond drops to $970. People often think bonds are boring state investments. They are, unless you're going to trade them. I mean, if I hold a bond until maturity, it's like watching paint dry. But if I'm going to trade them, because they vary depending on interest rates and credit risk, they can vary dramatically in price and value, and I can make or lose a lot of money. All right. Okay. Let's talk about some other concepts of corporate finance. And we'll start by talking about risk and return in the CAPM. We'll talk about efficient capital markets. And finally, we'll talk about capital structure. And then we'll move on to discounted cash flows and kind of finish up by talking about M&A in that context. So risk and return in the capital asset pricing model. To really understand this model, and I'm now on page 248, and what the capital asset pricing model is, the capital asset pricing model is essentially a way to understand, given a level of risk, what is my likely return on my investment? So at the end of the day, think back to algebra. I know that's a long time ago, perhaps, and no one wants to think back to it. But remember that algebra draws the slope of a line. The formula in algebraic formulas for the slope of a line. And all of corporate finance is really represented by what really this graph describes, which is as risk goes up, so much your return. That better be the way you think about your corporate finance life. Okay? If I take greater and greater risk, and I'm an equity holder of a company, a stockholder, I'm expecting a return of maybe 12%. Whereas if I'm a bondholder, in bankruptcy, who gets paid first? Bondholders, right? As an equity holder, I get paid last. In most bankruptcies, common stock gets nothing. At the end of the day, that's what they end up getting. So if I'm a bondholder, I'm really down here. Low risk, low return. Stockholder, high risk, high return. Visa card, high risk. For Visa, high return. Mortgage, low risk. They know they can take your house, foreclose on your house, sell your house, use the proceeds, satisfy the indebtedness, low return. No mystery. Okay? And obviously then, my objective as a company is to raise money on both of these points, and more here. That's why debt is good, because it lowers my overall cost of capital. Okay? That's why debt's good, and I'll explain that later. Debt is your friend because it's cheaper than equity. The more debt I have, the lower my cost of capital, the more the value of my company. And I'll show you that later. But before we get to any of this, let's talk about, as a prelude to the CAPM, something called modern portfolio theory, MPT. I don't have it in the materials, but I want to talk about it because it's useful. So on this axis, we're going to put risk. And on this axis, we'll put number of stocks number of stocks owned. Okay. And then I'm going to draw a line here. and put 12%. I'll draw this like this. Draw this. It's one stock, two, down here is about 20. 20 different stocks. Okay. Modern portfolio theory basically justifies mutual funds. It's a theory that developed in the 70s. It was promulgated by some people who used it to really prove, I think, pretty conclusively, that at the end of the day, you don't want to put all your eggs in one basket. We all know that instinctually from kindergarten, right? Don't put all your eggs in one basket. But this theory tells us not to do that in the context of finance, because it says that there's some risk of owning U.S. stocks that you can't get away from, because it's risk of the system. It's called systemic risk. And that I'm paid 12% a year for, right? At the end of the day, I'm paid this amount. No matter what stock I own, I expect to earn at least 12%, because that's what the overall market earns. And that's for the risk of owning a U.S. stock. It just is that risk. Okay? It's systematic risk. There could be another 9/11, heaven forbid. There could be something worse. Could be an overthrow of the government. I mean, it could be a massive recession, depression. Those are going to affect all stocks. 9/11 affected all stocks. And then there's what's called firm-specific risk. That's all this other risk. It's risk unique to the firm. If I own Boeing stock, it's risk unique to Boeing not being able to deliver 787s on time. Okay? If I own General Motors stock, it's risk to me of owning stock in a company that there's a major strike that isn't settled. The point of modern portfolio theory is if all my eggs are in this one stock basket, I'm not only taking on all the risk of the market, but I'm taking on all of firm-specific risk. But if I own 20 stocks down here, I manage to diversify my risk all the way down. So at the end of the day, if I have 5,020 different stocks, one of them could be Enron, could be worthless. But the other 19, worth 95,000, they should rise at 12% or 14 in some cases, and I should average a return that's about 12% a year, notwithstanding the fact that one became a zero. Okay? That's the point of mutual funds, diversification. Now let me tell you the negative of mutual funds, diversification. Because at the end of the day, if all I own are mutual funds, if all I own are index funds that mirror the market, can I ever outperform that which I am? How could I? How could I outperform that which I become? So my personal view, for what it's worth, is it's great to have mutual funds, index funds, ETFs, but at the same time, you want to take a few shots, right? You want to buy a few individual stocks that you hopefully research, understand, believe in, and you want to buy those even when everyone else is not buying them, because at the end of the day, eventually every dog has its day. If the company is a successful company, it may fall in and out of favor, but ultimately there will be a cycle where it'll be back in favor and you'll have a chance to make money. So a good example are real estate companies, home builders today. They're dramatically out of favor. I don't know how much further they're going to fall. I assume more. All right? But eventually, it's unlikely that we will go for a century without people building new homes. I'm going to bet against that. All right? So at some point, people are going to build new homes, and they're going to make money again, and their stocks are going to rise again. Are they going to rise as high as they ever were before? I don't know. All right? But I know that there's a cycle, and all this stuff cycles. All right? Sun Microsystems cycled. Cycled down to $2. Today it's $6. Okay? Once it was 40. It's just the nature of it. Smartest investor I ever saw was a guy that actually he was my client for a while, and he died. So he's no longer my client, unfortunately. And more importantly, he died. But smartest investor I've ever seen. His name was Bruce. And he came to me, and I got to know him. And at one point, he called me up and he said, "Look, I met with the president of this company because I've been following it for a while, called LabCorp of America, and it's a great company. They do urine and blood testing for all the major hospitals in the United States. So most hospitals, they don't do their own testing. They send it off-site. The results come back. You really have a monopoly, this company, LabCorp, for all the big hospitals and many of the secondary hospitals." And so he said, "I really like this company. I believe in the stock. At one time it traded at $50. Now it's at $9. So Ed, I want you to buy me 100,000 shares at $9. He's a wealthy guy, obviously, right? Like, okay. And he goes, "I think you should buy some too." I go, "Okay." Goes down, next, month, goes down to $7. Calls me up, he goes, Ed, buy me 200,000 more shares. Like, Bruce, we're going the wrong way on this thing. You know, it was 9, now it's 7. Just buy me 200,000 more shares. Like, okay. Goes down to $5 a share. Calls me up. Ed, buy me 300,000 more shares. I'm like, Bruce, we were at 9, we're at 7, we're at 5. You know, we're losing our you-know-what on this. I don't think that's a good idea. No. I met the CEO. I've talked to him repeatedly. I've studied the market, the business. Buy 300,000 more shares. Okay. The U.S. government announces that they're investigating the company for overbilling Medicare and Medicaid and are likely to assess a fine, which is probably going to be the largest fine for this type of violation in the history of the United States, estimated at $1 billion. Stock trades at $3 a share. What, of course, happens? Calls me up. Says, buy me 500,000 more shares. Like, Bruce, we're totally going the wrong way. I mean, it's like, no, buy me 500,000 more shares. Then the co-founder of the company, a guy named Ronald Perelman, not a stupid individual if you've ever heard the name, he's a smart corporate raider type, investor type. He decides he wants to sell his stake in the company that he has left. He co-founded the company. He's selling his stock. Never a good sign, right? Okay, especially Ronald Perelman, because he's not stupid. $1.50 he wants to sell it for. I learned of this through some third party. And he says, do you want to buy it? Does your client want to buy it? I'm like, I'll check. Call him up. Bruce, there's 1.5 million shares at $1.50. Do you want to buy it? Buy it. Like, are you sure? Buy the stock. Buy the stock, right? A year later, the stock's at $43. He makes $80 million, okay? Now, what's the lesson of all this? I mean, lesson is that, the market's often wrong in the long term. And you just have to have the guts, the wherewithal, the ability, the faith to keep buying even when it's going down. I mean, that is the right decision when a stock goes down usually, to buy more of it, not to run. All right? It's amazing because as Americans, really the psyche is buy everything on sale but stocks. Ever notice that? I mean, we're trained that if things are on sale, we should buy them because they're on sale, good deal. But if it's a stock that's going down, people are like, I don't want to buy that. I want to buy stocks that are going up. Well, why? You want to buy them when they're low and sell them when they're high. That's the way it works, right? That's how you make money. So he did this so many times. I did see him get spanked a couple times because it happens. It's the nature of being an investor. You cannot be perfect. Warren Buffett loses money. And if you're worried about losing money, you can't be in the market, okay? Because you're going to make mistakes. Or even if you're right, you're going to be proven wrong in the short term or whatever, all right? So, but, it's hard to hit a home run without being a bat. And you got to get up there and swing. And he did. And he swung and hit a lot of home runs. And, he struck out a lot, too. But he hit a lot of home runs. And at the end of his life, I think he hit a lot more home runs than he struck out, right? At least from a financial perspective. So the point of this is, I like the idea of mutual funds and ETFs, but you got to take a few shots because that's how you're going to really build wealth. Otherwise, all you're doing is trading really with the market. You're the market for whatever that's worth to those who care. Okay, let's talk about the CAPM now. The CAPM, I've given you the formula. Really all it does is draw a line here because it's, at the end of the day, an algebraic formula. And what it tells us, if we look at the formula, which we can find on page 248, it starts with this idea of beta. We've already talked about what beta is, right? And then it says the CAPM determines the required rate of return of an investment by adding unsystematic and systematic risk. The required rate is a risk-free rate plus a premium for unsystematic risk. So all that's really doing is it's saying, given the level of risk I'm taking, this is the return I should get on my stock, all right? And so I've given you this formula. It says required return on an equity investment equals risk-free rate plus average market return minus risk-free times beta. So let's just do that. So what's the risk-free rate? U.S. Treasuries, 5%. Plus the average market return rate, 12. Minus the risk-free rate, 5. And what's the company? Let's say the company's Sun Microsystems, trades under the ticker Java, right? So it's 3 as a beta. So it's 5 plus 3 times 7, or 5 plus 21. Five plus 21, or 26. So if I own that stock, on average, I should expect a return of 26% this year. Okay? If I don't get it, many mutual fund managers will say, oh, given the risk, didn't correlate with the return, I want to be a seller. Okay? So the other reason that this is interesting, leaving aside all this, is because this is the only economic or finance theory ever expressly adopted by the U.S. Supreme Court. Now, I take great comfort in the areas that I teach in because the U.S. Supreme Court has not screwed them up very much because it's not ruled very much in any of these areas. So I always tell my students, the great news about this class, whatever class it is there aren't a lot of U.S. Supreme Court cases. So the odds of it being completely fouled up, very low. Right? There's no balancing tests or other nonsense to screw this thing up like they have everything else. So they have, however, ventured into securities regulation on occasion, and that's where this case, the one case we're going to talk about today, arose. It's a famous case called Basic versus Levinson, and it adopted the capital asset pricing model. What happened in Basic, and let me take the facts of Basic and talk about them in the context of Martha Stewart because it's a little more interesting. So Martha Stewart ultimately was convicted and served time in jail for lying to the government. Everyone remembers that, right? And she lied. Here's the amazing thing I find, at least. She lied to the government about a non-crime. Isn't that interesting? That you could be convicted of lying to the government about a non-crime. Because obviously the crime she lied about, purported crime, was insider trading, for which she was never charged nor convicted. So obviously it wasn't a crime. All right? So it's an interesting case because I think it's one of these cases where, as we look back historically, the government will look at this case and say, we won the battle, but lost the war. Because, of course, the net effect of the Martha Stewart case is that what, as a white-collar criminal defense lawyer, will you tell your client to do when the government comes to talk to them? I'm not talking. Well, but we have some questions to ask you. Fascinating. I'm invoking my right under the Fifth Amendment not to speak. Well, what do I do? Nothing. All right? And it's pretty hard to lie if you don't talk, I think. Okay? So it's actually an interesting case because I think they've kind of put themselves in a position where long term that's become now the norm, and it's going to be harder to get indictments because you rely a lot on people talking, using that information. So, but whatever. So anyway, so here's the Martha Stewart case now, the insider trading side of the case, not the one that she was convicted of. So let's think about what insider trading requires. Non-public trading on non-public material information. Okay, so let's go through it. Did she trade Income stock? Yeah. Was it non-public? No question, I think. There was non-public information she traded on. Was it material? That's the key. That's what all the insider trading cases are about. The government can always prove you traded. They can always prove it was on non-public information. Now they're left to argue, the defendant, that it was not material. It was non-material information. How do you determine materiality? You rely on Basic versus Levinson. And here's what the Supreme Court said in Basic versus Levinson. The Supreme Court said the following. It said, look, let's look at Income stock that day. Well, it traded down 10%. Okay? What's the beta of Income? Beta is 2. The overall market that same day traded down 5%. So what does that imply? If the overall market went down 5 and the beta of this stock is 2, we'd expect it to go down 10. So it had nothing to do with the news. It traded down like the overall market did that day. It was external market factors that led to a decline in the stock price, not the information. Now, obviously, if the stock went down 25% and had a beta of 2, and the market was down 5, then that's material information, because it obviously went down in a much greater way than one would have expected based on the overall movement of the market. So all these cases have revolved around now proving materiality and bringing a parade of experts in to show, was it material or not material, and using this kind of analysis to do that. The thing I find most fascinating about this, of course, is at the end of the day, what is this? It's the Dow Jones, the S&P 500, all similar-sized biotech companies to Imclone. You see, if you're a good expert for the defense, you'll always find something, right, that's the market proxy that you want to use. And you'll be able to show, come on, it fit the market perfectly. There's no correlation between this information and the movement. It just moved as a result of the market. Of course, the government's going to have its experts. I testify for the government, and the government's experts are going to be, no, we disagree. The right market is the S&P 500, and as a result of that, we think it should be X. Right? So it's a fascinating issue. I mean, never got to it in her case. I always think it's interesting because I think, as a defendant in an insider trading case, right, your chances of prevailing are relatively slim. That's at least been my experience. Because I think what the jury hears is that you made $34 million, and they're convinced you're guilty of something, right? I mean, because, you must be, because no one could ever make that much money in their lifetime, and so you obviously are guilty of something. It can't be the case you weren't, all right? So, the old saying, if the government could get the grand jury to indict a ham sandwich if it wanted to, and there's a lot of truth to that. I think. Efficient capital markets hypothesis. So let's skip ahead now to the next slide, and that is actually page 249. And if we look at that for a minute, what is ECMH? Efficient capital markets. Well, this is the hypothesis that was advanced. It's been advanced by numerous people. There's a lot of empirical evidence to suggest it's true. And the hypothesis suggests as follows. It says that basically stock prices accurately reflect public information. It's another way of saying, if I buy IBM today at $130 a share, I paid the fair price today for it. I never paid less than the fair price. I never paid more than the fair price. When I bought Enron at $80 a share, it was the fair price. Now, new information comes out. Enron's a fraud. It goes to zero. But the day I bought it, everything known about it was reflected in its price. Burton Malkiel wrote a famous book on this theory, and he expressed it in a very, I think, nice, easy way. And again, there's a lot of empirical evidence to suggest this is true. He said, look, if you took a monkey and put all the New York Stock Exchange ticker symbols on a wall and handed the monkey 5 darts and said, monkey, fire away at the wall. And the monkey hit 5 stocks, and I bought those 5 stocks. And then I had an analyst from Goldman Sachs who recommended I buy 5 stocks. After 5 years, what we would see is that the monkey and the analyst had performed the same. Now, that seems so absolutely preposterous, except that the Wall Street Journal did it for 14 years. I don't think they literally brought in a monkey, but I know they randomly selected stocks. And they compared those randomly selected stocks that were generated by computer against analysts that they brought in every quarter. And here's the amazing thing. Over 14 years, the pros slightly beat the darts. But when you factored in their cost, they were about even. All right? So brokers don't like to hear this, by the way. To compare your broker to their face to monkey, they're not exactly enamored with that. But the reality is, brokers are good at asset allocation. They'll set you up in an asset allocation plan. But to pick stocks, come on. If they were so good at picking stocks, why are they a broker? Why don't they have more money? Why are they calling you and telling you to buy a stock? Let me ask you, you know what it's like to take the brokerage exam? Anyone take it? Okay, I took it, right? Did you find that a challenging exam?
Series 7.
Yeah, Series 7.
Easy to pass.
It was easy to pass, right? I mean, did this happen to you? Did they put the mirror under your nose and if it fogged up, you passed? Because that's how it worked for me. I mean, it's a joke, okay? A good broker is just a good salesperson. That's another way of saying that if I had them selling cars, tomatoes, diamonds, or stock, they'd sell it all, right? The best brokers are not the most brilliant stock pickers at Goldman Sachs. They're the best people at dialing the phone and getting people on the phone and convincing them to buy stocks. In fact, Goldman knows this, so Goldman won't even let them make suggestions. They're like, here are the 100 stocks you can tell people to buy or sell. But I want to tell them more. Shut up. Here are the 100 stocks. If the client calls you and says they want to buy something off that list, take the order, make the money, but do not say a word more than that. But what if they ask my advice? Shut up. Okay? We have a focus list. These are the stocks on the list. Never get off the list. Because, of course, they don't want the liability of these lunatics telling people to buy stock that, that has nothing to do with reality. Okay? They don't want that they do not want that risk. So it's kind of, broker, there's nothing wrong with having a broker. There's nothing wrong with having financial professionals. But I will say this, okay? Everyone in the room successfully navigated through law school, are in practice in one way or another, or were, or in business, or, y'all have the ability to do exactly what they do, right? And you care more about you, I'm going to guess, than they do. You think that's likely? So at the end of the day, who cares more about your money than you? That person does not exist, right? So I would just encourage you, use the tools you have to learn about this stuff so that you can at least make sure that you're not completely putting your future in the hands of someone who's 26 who knows nothing except how to call you and tell you what to do. That's all they know how to do in a lot of cases. I mean, I had a lot of people like this that worked for me. They were great salespeople. But if you really started asking tough questions about Sun Microsystems, they were like, I heard of it. And that convinced me actually to sell my business. You don't care perhaps, but the real epiphany I had was I realized I had all these salespeople who literally were calling other people to generate commission, right, so they can eat, which is not it's a goal, it's a noble goal, I understand the goal. But at the end of the day, they don't really care about me, right? They don't really care about the customer. They only care about their commission. And I think my personal view, as I look back, was it would have only been a matter of time before somebody did something stupid, which would have, of course, come back at me, right? Because the NASD or the SEC, they're like, okay, well, he's just an idiot broker. You own the firm. You're liable. So when I was like, I don't like this anymore because I have to worry about lunatics out there who, they do crazy stuff. And there's some percentage of a lunatic group in any group. And, especially when they're salespeople. I mean, that's the likelihood of some of them being insane is a lot higher. Okay, capital structure policy. Capital structure policy. So Modigliani and Miller advanced this, and they won a Nobel Prize for it. They said, look, in a world with taxes, companies should have 100% debt financing. Now, you can't. The IRS won't allow that. They recharacterize the debt as equity, a portion of, but whatever. Their central thesis is a sound one, which is the debt is good for a company. Now, the reason they say that is because of what I point out on page 250. So let's look at 250 together for a minute, page 250. And I've got 3 states of the world here on page 250. Company with no debt, company with 25% debt, company with 50% debt. See all that? Okay. If we go down several lines, you see the pre-tax costs of debt, just staying with the 0% debt. Company has no debt. Pre-tax cost of debt is 7%, 0.07. See that? And then I have a tax rate of 34%. And then I have my after-tax cost of debt of 0.0462, which is another way of saying that because I can deduct my interest expense, I get a tax deduction for interest expense, just like you do for your mortgage interest, right? Unless you're over a certain income threshold or the mortgage debt is more than $1 million. But assuming you're not, then you can deduct your mortgage interest expense. The government is subsidizing your interest payments. Take advantage of it. It is a no-brainer. It's for many of us the only thing the government will ever do for us, okay, from a financial perspective. So take it. It's their gift to you. So when rates are 5%, in effect, they're 3%. Okay? It's really how it works. And companies have an interest expense deduction that's unlimited. So really, when they're borrowing money at 7%, in effect, they're borrowing it at 4.6. Okay? That's why buying real estate in a house and using leverage to buy it, assuming it appreciates, is a no-brainer, right? Because let's do the math. This is why my friend says, debt, $1 borrowed is $1 earned. Okay? So let me show you why, right? It's pretty obvious, but I'll go through it. So I go buy a house and I put $100,000 down. That's my equity. The house costs $400,000. Okay, so I borrow $300K, right? 10 years goes by. House increases in value to $800,000. Okay. I sell the house. At the time I sell the house, the debt that I paid down is $250,000. Because I'm paying on a 30-year loan, most of the first 10 years, there are interest payments, very little affects principal. So what's my net on this house? 550K of equity. What did I put down? 100 grand. I made 5.5 times my money. Pretty good. And you know who made that possible? The bank, by loaning me the money I needed to buy it. I used leverage to buy an appreciating asset, and I have all the upside. They have none. The bank has zero upside, right? The bank can only get its money back plus interest. That's the deal I cut. So it is a no-brainer to borrow money to buy an asset that goes up in value, if you can get the money, right? And because real estate, my personal belief, is there's 3 ways to become wealthy in our country. The first one you can't really affect in a meaningful way. It's called inheritance, okay? That's number 1. The second way is own a business. And the third way is stock and real estate speculation. Those are the 3. What's the 4th? Lottery? What's that? Marry. Okay, well, I'll start with number 1. I'll say marry, inherit, kind of all the same kind of thing there, right? Okay, but at the end of the day, other than those methodologies, is, I'm sorry, but working by the hour, I think we could all agree on this. It's hard to make a lot of money working by the hour because you're always facing the one issue. Pretty sure there's only 24 hours in a day, right? And even if you're aggressive in your customary treatment of hours, it's still tough to make a lot of money per hour. It just is. Okay, so in stock, real estate speculation, here you go. Here's the beauty of real estate speculation. I get all the upside. Leverage is my friend. Okay, now companies aren't stupid. They do the same thing. That's why there's a lot of LBOs, leverage buyout, because I'm going to go borrow 90% of the money. And if things work out, I get all the upside. Things don't work out, and the bank ends up, I blow my equity. And that's the negative here, right? Obviously, if the property goes from 400 to 350 in value, I lost 50,000 of equity. That's the negative, because the bank is cushioned against that. They have the 25% cushion there. That's a risk. All right? Go down a couple lines in 0% debt. So after-tax cost of debt is 0.0462. Because of this interest expense deduction. Then go to cost of equity. See that? 0.139. That's how much it costs me to induce people to buy my stock. They have to get something to own my stock, right? They're demanding a 13.9% return. That return can come in the form of me paying them dividends and come in the form of capital appreciation. But nobody owns stock for no reason. They want a return. And notice how that goes up. With no debt, it's 13.9. By the time it's 50% debt, it's 16.8. More debt, more risk. More risk, higher return. I mean, there's no bankruptcy risk when I have no debt. What's the bankruptcy risk? Am I going to file bankruptcy when I owe nobody any money? Why? How could I? I guess I could be sued in some tort claim or something. But at the end of the day, it's unlikely. When I have 50% debt, a lot more risk, equity is going to demand a higher return. Okay, now get to the next line, WACC. See that line? Weighted average cost of capital. Very important concept. WACC, weighted average cost of capital. Okay, what is weighted average cost of capital? It's cost of equity. I finally figured out this pen. I was pushing a button. There you go. User error. Plus cost of debt times percentage of debt. So the way this works is it's cost of equity times percentage of equity plus cost of debt times percentage of debt. So in the first example, cost of equity is 0.139, right? Times how much equity? 100%. That's all I had. Cost of debt, 0.0462. Percentage of debt, 0. So what's my WACC in the first example? 0.139. Everybody see that? It's just mathematical expected value. Is there no mystery here, right? Okay, go to the next example. Cost of equity now goes up to 0.151. How much equity do I have? 75%, because I have 25% debt. What's my cost of debt? 0.0462. How much debt do I have? 0.25. If debt is cheaper than equity, and I add debt, what must happen to my WACC? Debt is cheaper, so I add debt. The WACC has to go down, right? So it goes from 0.139 to 0.127. Everybody see that? And the last example with 50% debt, okay, so I can make this work. So now I have 50% debt. My cost of equity is 0.168. I have 50% equity. I still have the 0.0462 cost of debt, and now I have 50% that. So my overall cost of capital goes down to 0.108. Why do I care about any of this? Because my company is worth, and that's all this is about, it's making the company as valuable as possible. Price of a company is equal to its cash flow divided by its WACC. Well, if this number stays the same, and I lower WACC by adding debt, Modigliani and Miller proved that that should increase the value, and does every time, the value of my company. Because I'm now accessing the capital markets for a cheaper cost. That improves the overall value of my company. And usually the inflection point is 50 to 60% debt. If I have too much debt, what happens to my cost of equity? It's going to go up because the people, if I have 80% debt, the people who are the equity holders are going to be like, oh my God, this is crazy. I don't want to be owning this thing unless I'm getting 30, 40% returns because it's so much risk. So the inflection point tends to be at 50 to 60%. So if you look at the balance sheet of Target, 56% debt to equity. Walmart, 57%. That's not a coincidence. Okay? They're doing it to manage their capital structure to increase and optimize their value for the benefit of shareholders. That's why they do that, because debt is cheaper than equity. It's in your own personal life, it's the same, right? You want to do the same thing. Now, obviously, as you age, you don't want to have a lot of debt on your personal balance sheet. But certainly, when you're younger, it's not a problem to have appreciating debt, debt for appreciating assets, because you're being subsidized to do that, and you can take advantage of leverage. If we go back to my capital structure policy slide, page 249, there's some other factors that companies consider and parties consider when they are issuing debt, or whether or not to issue debt. So we talk about those in terms of FRICTO. One is debt is inflexible, right? Debt involves risk. Debt involves the need for income. If I take your money as an equity holder and I never make a nickel, I don't have to pay you anything, right? But if you're a creditor, I got to write you an interest check every month, quarter, whatever. Control. The great thing about debt is it allows me to maintain control, right? Bill Gates is a rich guy by any measure. He'd be even richer if he was the sole owner of Microsoft. And had he financed it with only bank debt, he would be, right? So debt is great because it allows you to maintain control. Timing. Sometimes the markets are ripe for equity, sometimes they're ripe for debt. In 1999-2000, the stupidest business plan, if it ended with .com, got financed, right? Equity markets were extremely vibrant back then. If you don't believe me, watch the movie Startup.com, one of the great business movies you'll ever see. It's a movie filmed in real time about three knuckleheads who start a company that's a .com company. And at the time the movie's being filmed, no one knows how this is all going to end. They don't know how the era is going to end. They don't know how the company's going to end. So that's why it's really kind of a cool film. Anyway, I'll tell you the ending. These guys, who are completely clueless generally, raise $60 million and proceed to turn it into $20,000 of revenue total. Not $20,000 of income, $20,000 of revenue in 3 years. All right. Everything with the .com got funded back then. I remember, somebody came to me with a business plan, and it was to sell food, pet food, over the internet. Now, I have 2 dogs. I love my dogs. But let's think about the stupidity of Ed's investment for just a second. People are going to sign onto the internet, and they're going to order a 40-pound bag of food that's going to cost $30 to deliver to them. Instead of getting in a car and spending 15 minutes and $5 of gas. Who are these people? I will tell you the answer. No one, okay? So that's how the company did. Sales of virtually zero. All right? But, everyone thought if you put .com after a name and every business could just be turned into a .com. Some of them can be, right? Travel, a great .com business. Okay? Pretty much of a no-brainer. You don't involve delivering anything. It can see a lot of prices. Insurance, a great dot-com business. But some things don't fit the dot-com model, as we found out the hard way, many people, right? So it is what it is. But, you get the flavor of this. The final factor is some companies just don't like culturally debt. So 3M, a company local to me, they don't like debt. And you can tell them a million different times, as many people have, that it would be good to have debt. The company would have more value if you had debt. Like, well, we don't culturally like debt. What do you want me to tell you? Okay, I mean, if that's their cultural perception, can't change, right? Okay, let's talk about discounted cash flow analysis. The interesting issue here that is always being grappled with is, if I want to open a new store or a new office or develop a new product, what is it going to cost me and what am I going to get? It goes back to the 4 key elements we talked about. Start with what am I investing, what am I going to get, when am I going to get it, and how uncertain am I of it. That's a finance problem, always those 4 elements. And in any finance problem, you are focused intensely on the cash flows of the project. And there's 2 temporal elements there. One is initial cash flows when you start the project, and then once the project's up and running, what are the cash flows subsequent to that? So those are the 2 cash flows you want to really analyze. And in each case, there's cash uses and cash sources. So sometimes cash is going out, sometimes it's coming in. You want to compare the going out with the coming in and see if it's a positive net present value project. That's the key finance phrase we use, positive net present value project. You evaluate projects on a discounted basis, a discounted cash flow basis, and you ask the question, are they positive or negative net present value projects? There was a survey done a year and a half ago in CFO Magazine where it asked corporate CFOs of the 500 largest companies in the US, how do you evaluate projects? 498 of them answered with discounted cash flow. The other 2, I think, should have been fired. I have no idea what they were thinking or what their answers were. I don't know. Again, who knows what they were doing. But at the end of the day, this is clearly the methodology that's used by the majority of people. And when we have cash flows initially, or cash uses like construction or inventory I've got to buy, or equipment I've got to buy, or increase in my accounts receivables, and there's cash sources like selling old equipment or increase in my payables. And once I'm up and running, I'm going to have cash sources like revenues or royalties and cash uses like cost of goods sold, selling costs, general and administrative, and taxes. So I want to take you through an example because I understand this makes a lot more sense with an example that's concrete. My example is General Mills, which is local to me, is considering a $100,000 investment in a new machine for a plant in Anoka. Anoka is a northern suburb of Minneapolis. You never want to go there. If the machine is purchased, you're going to have additional sales of $80,000, okay, which are going to be made each year. The cost of goods sold, we estimate, is $20,000. We estimate the taxes are going to be about 30%. And increased sales are going to require us to hold another $10,000 in inventory. The General Mills is going to offset the increase by increasing its payable to farmers by $8,000 for oats. And at the end of 3 years, we think the machine is going to have a value of $10,000. Now, what I want to stress to you with all the stuff that I just said, it's all assumptions. It's all good faith-based estimates. And with any of what we're about to go through, garbage in, garbage out. All right? So if I make assumptions that are wildly flawed, I'm going to end up with junk, all right? So just bear with me on this, because the reality of evaluating projects is you've got to have good data to start with. Because the math I'm about to show you, really with a spreadsheet, any monkey can do it, all right? It's not some hugely, profoundly significant thing. And this is how analysts value companies. When they're analyzing whether or not a stock's fairly valued or not, they run through an analysis not dissimilar from the one I'm going to show you in the next set of slides. But it's their assumptions that matter. So at one point, Qualcomm, the cellular licensing technology company, they were valued, the stock traded at $600 a share. Today it's $41, okay? And at the time it was trading at $600, analysts, I remember reading reports, said Qualcomm should trade to $1,000. And that was true, and they had flawless spreadsheets behind it to support their view. It was true if the growth rate of Qualcomm had continued at the rate it had up to that point. The only problem with that was that Qualcomm would have continued to grow at the rate that would eventually make Qualcomm the gross domestic product of the United States. See, I don't think that was likely. It just seems like it's aggressive to me, okay? So when you see stuff like that, you got to kind of pause and say, okay, garbage in, garbage out. I mean, yeah, the spreadsheet was magnificent. And there's no question that all the fields were right. And if you plowed through it all, they clearly knew how to use an Excel spreadsheet. But if you start with garbage in, you end up with garbage out. Okay? Mathematics is perfect. It's just the assumptions are trash. Okay, so go to page 254. If you look at 254, I've now sketched really my example here, which I'm going to stay on the board. So I put $100,000 in year one for the new machine. I increased my inventory. That's cash out of $10,000. So it's negative 100, negative 10. Increased my payables, offset that by a positive 8. So my total cash flow in year 0 was a negative 102. Everybody see that? Then in year one, I generate revenue of 80. I have cost of goods sold, and my assumptions of 20. My taxes are 9, and I've calculated that for you at the bottom, so you can look at that at your convenience. And so at the end of the day, I have 51 of cash flow in year one, 51 of cash flow in year 2, and 61 in year 3. So many people would stop here, and they would say, oh, well, okay, I've got 102, and I've got 51 plus 51 plus 61. So that's 163. Well, 163 is greater than 102. It's a positive project. I do it. No. That's comparing apples to oranges. Because I'm paying 102 in today's dollars. What is 51 a year from now worth in today's dollars? 51 2 years from now worth in today's dollars. And 61 3 years from now worth in today's dollars. That's the right question. And the way you figure that out, of course, is you just kind of cash flow present value formula I gave you before, which is, remember that formula? Cash flow divided by 1 plus R to the T. Remember that? So in this case, it's 51 divided by 1 plus R. What's R? I assume for the sake of this, you'll see on page 255, that R is 10%. Okay? And it's to the first power. Plus 51, because I'm 1 year out, divided by 1 plus 0.10 to the second power, plus 61 divided by 1 plus 0.10 to the third power. I add all those numbers up, because you see them on 255. 51,000 a year from now in today's dollars is worth 46,000. You know, it's another way of saying, if I put that 46 grand in the bank and earn 10%, what I'd have in a year is 51. That's all I'm saying. Okay? Look at the next line. 51 in year 2 is really worth 42,000 in today's dollars. And 61 in 3 years is worth 45,000 in today's dollars. So again, if I put 45 in the bank, in 3 years I'd have earning 10% 61 grand. So I add all those numbers up, and I find that those numbers really, on a present value basis, are 134. I take the 134 minus the 102, and I end up with a net present value of the project of 32,000 some. Okay. So we'd say this is a positive net present value project to the tune of 32,000. If I'm Microsoft and I'm evaluating 6 projects, I evaluate them all this way. I figure out which has the highest net present value, and I do that one. Now, what you're going to obviously ask the question, I think everyone in the room asks the question, well, how do you figure out, this number, and what's this? All right. Well, T is timing, so we can kind of figure out the cash flows from there. But then people often ask, well, what is R? Well, R is whack. But it's really never the real whack. Because at the end of the day, what happens at the corporate level is that people, here's what, I'm in charge of opening new stores for Target. And they say, Ed, go investigate Ohio and figure out new places to open stores in Ohio. Evaluate those using a weighted average cost of capital. Any project you think about, decide to evaluate for the purposes of deciding whether or not we want to undertake it. Use a WACC of 25. Their WACC is 10. Why do they tell me it's 25? Because they're they don't know it? No. They know that if I'm a project opener, I'm going to cheat to open projects, right? I mean, show me someone whose job it is to develop new stores, new drugs, new developments, who isn't optimistic in their assumptions. Because if they're not, and every time I look at a store, I come back to Target and conclude we shouldn't open it, after doing that for 2 years, they might get the bright idea that, why are you here? Have you now told us that we should never open a new store in Ohio, that the market's saturated? I guess that's one way to look at it. Then why are we paying you anymore to tell us no? Huh? So people, the company, first of all, the company wants to be cautious. And second, they want to deal with human nature. And so they'll give me a whack of 25%, and they'll say evaluate projects that way, knowing that their real cost capital is 10. And then they'll err. They won't do as many projects as they could, but the ones they do, there's a lower probability they won't work out. Right? The whack is the whole thing, right? Because look at page 257. And this is a different example, which is developed on 256, which we don't need to really spend time on. I just want you to understand it briefly. But if you see it, in the middle of 257, there's an NPV of 4% and an NPV of 10 and 15 and 20. And then go to the right-hand side. Notice with a 4% NPV, this is a positive $120,000 project. But with an NPV of 20, it's a negative $31,000 project. See the difference there? Okay. So what I'm saying by saying that, really, is that at the end of the day, if the uncertainty is very high, the value of the project could be a negative. And if it's a very certain cash flow project with a 4% NPV, I'm as certain about this as I am the US government paying me 5% a year, then it's going to be a very high positive NPV project. Right? So that's the big driver of evaluating these projects. Okay. The other thing I'll say, which should be apparent to you, is that if we go back to this example just for a brief moment, this is year 1, year 2, and year 3. But suppose this is really year 11, year 12, and year 13, and I don't have any money that comes in the first 10 years of the project. Now this is going to be to the 11th power, the 12th, the 13th. You know what? This is going to be a negative net present value project. There's no way I would do this. Okay. And what that means, by the way, is in the United States, because we use this technique, and everyone now around the world does, we don't care about anything but the short run. Okay? John Maynard Keynes once said it best, I think. Don't worry about the long run. It's irrelevant, because in the long run, we're all dead. And so you often hear the criticism, oh, American companies only care about the short run. That's all you should care about. The thought of caring about the long run is ludicrous, because in the long run, the fact that I can develop a drug that cures whatever 100 years from now, you know what the value of that is? 0. Because 100 years from now, even though I get $10 billion 100 years from now, if I spend $1 billion today, I'm way behind. I just got buried. And I know there's a societal benefit. I get it. I agree with that. But the reality is companies don't do things for society's benefit. They do it to make money. And so that's a bad equation, right, for them. It's just the way it is, right? So coupled with the fact that the average tenure of a CEO is 4.8 years, they don't care about the long run. They just don't. And I remember in the 80s, people said, oh, Japan is a much better economy, and the companies in Japan are much better because they care about the long run. But I think what we saw in the 90s is that the long run idea isn't the best idea, because it's really hard to predict what's going to happen in the long run. Do you think that in 1975, if I'd gotten a bunch of people together in a focus group and said to them, there's going to be this thing called the internet, and brokerage firms as we know them will no longer really exist because people will be able to trade stocks for a commission of $9. Travel agents, they'll be gone. Those people would have looked at me like I was insane. They'd be like, where's this coming from? What kind of lunatic are you? Right? I mean, we don't believe that. That's never going to happen. Right? So, or if you told people that Beta was going to lose to VHS, you'd be like, no way, better product. Where did that end up? Or how many times have you heard Apple's a better operating system than Microsoft? But there's a little difference in value of companies there, isn't there? Even though one is a superior product, arguably, right? One has absolutely trumped the other 100-fold. So the idea of somehow the long run, being able to predict the long run, it's like a weather forecast. We all know they stink anyway, right? I mean, forget about telling you what's going to happen 5 days from now. They can't even tell you what's going to happen tomorrow. But assuming that they're closer to tomorrow than 5 days, they have no clue about 5 months, 5 years or anything else. I always find the whole weather forecast thing remarkable because if you watch it, 90% of it is devoted to telling you what happened in 1906. Like somehow I care about 1906. I want to come back as a weather forecaster because you think about it, they never have to be right. That is the standard. It's really a good job. I like to do it. Okay, go to page 260. I don't know, maybe yours are good. Minneapolis, ours are terrible. Doesn't matter what channel, they never get it right. So there's 3 years where M&A valuation really is interesting, I think. Maybe we'll add a fourth, which is the most recent one, the 2000s. But we had the 60s where there was a lot of M&A activity. Most companies are trying to become conglomerates. And the theory was, I'll grow cotton, I'll make clothing, I'll sell the clothing to the customer, the end user, the consumer. Most of those conglomerates really ended in disaster. Very unsuccessful strategy for the most part. Then there was the great 80s, the decadent 80s, if you will, thrilling and nasty, a lot of finance transactions done for M&A purposes, or a lot of M&A transactions done for finance purposes, really. And then we had the strategic alliances of the 90s, and I think we're back to sort of the 80s in many ways in terms of finance transactions, because they're doing transactions generally for an arbitrage, right? I mean, I take a company public, then I take it private, then I take it back public again, you know. Hedge funds are actively involved, private equity, et cetera. So you've got these 4 years where M&A activity has been very robust, very profound. And I think that begs a lot of questions, including, well, is it good? And we'll talk about that in a minute. Or why are most acquisitions a disaster? And when we talk about that, I think you'll understand or appreciate how you value companies for that purpose. But before we get to that, let me talk a little bit about a non-quantitative theory. We spent the whole day talking about numbers, really. Let's talk a little bit about this theory, the theory of the firm. A great theory. Developed in the profoundly important theory. It was developed in the 20s originally by 2 guys from Harvard, Burl and Means. And they said the problem with corporate America is people who own companies don't run them. And whenever you have that dichotomy of ownership and control, you have a situation where the people who control it run it for their benefit and not the people who own it. So this is an insight of human nature. If you don't appreciate, none of this makes sense. If you don't believe that people act in their own self-interest, none of what I'm about to talk to you about is helpful, okay? But I do, all right? I believe that people care more about themselves than me, all right? It's okay, you know? It's the way it is, right? So I believe that that's the case. And if you believe that that's the case, then Jensen and Mechling came along in the 70s, and they said, you know, Burl and Means are right. There's something we call the separation of ownership and control. The people who run the company don't control it. That leads to a principal-agency dichotomy. People who are the principals, shareholders, rely on agents who act in their best interest, not the interest of the principal. And that means that everything, corporate law and the economic system, are about how do you align the interests of these 2 parties. And I think if you don't believe this or don't want to believe it, read the book Freakonomics if you haven't read it. It's a great book. And the insight of the book of Freakonomics, I believe, among others, is that at the end of the day, agents do what's best for them, not for you. All right? And if you don't believe that, you either found the one agent in the world who isn't like that, or it just may be the case you may be projecting good behavior that doesn't really exist on this person. Because at the end of the day, they care about themselves. Okay? So let me tell you my quick babysitter story. So I have a son. I'm very fortunate. I have a 4-year-old son. And I go to my friend's house, and he has 2 kids. And we're in California, and we all want to go out to dinner. So he goes, oh, I've got this babysitter, and she'll come over, and she'll watch our kids, right? I'm like, okay. And, I go through the whole quiz. How long do you know her? Blah, blah, blah. But she's a very trustworthy person. I find out, whatever. So anyway, he goes, now, Ed, what I don't want you to do, though, is when she comes over, don't talk about paying her. I'm like, what are you talking about? He goes, well, I pay her a certain amount. I don't want you giving her more money, because if you give her more money, then we'll be in a weird situation here, because then she'll expect more money from me the next time. She'll think I'm being cheap. Now, this is a guy who's he lives in a $5 million house, okay? I'm like, I don't know that that's a good idea. He's like, well, what do you mean? I go, well, like, what's more important to me than my kid? Like, nothing, right? So why would I want to be cheap about my kid? I don't like this idea. He's like, well, no, don't screw this up, okay? Because, right now I got her for a good price, and you're going to mess this up if you offer her more money. And I'm like, okay. So she comes to the door. I'm like, come over here. I'm like, because I can't do it in front of him, right? Because he's already told me don't do this. So she comes over there. I'm like, here's the deal. I come back, my kid's happy, you get $100, okay? If he's alive and happy, you get $100. That's in addition to whatever my friend's paying you, and I don't care. Now, that's the way to solve the agency problem, isn't it? You'll never make her love my son like I do, but it's the only thing you can do. You have to give people the same interest, align your interests with theirs. It's the only way you can do it. So if you think about stock options, that's why stock options are incredibly popular. They exploded on the scene in the 70s because of the insight of Jensen and Meckling. They said, how do you make corporate managers care about the owners? You give them stock options. Because what do the owners care about? The stock price. So now what do the corporate managers care about? The stock price. See how brilliant that insight is? Now, has this gotten carried away maybe? I don't know, all right? If Barry Bonds makes $30 million a year, is it wrong for Steve Jobs to make 200? I don't know. I'm not here to talk about what is right, wrong. I don't care personally about that. Everyone has a different perspective. But the reality is, it's a great way to constrain managerial abuse or to align the interests of managers with their shareholders. And there's other techniques. The legal system's all about that if you think about it, because the legal system says, if I can get the page to flip here. Well, you flip the page manually. If we go to page 261, you see there's legal factors that reduce agency costs, right? I mean, legal factors like corporate democracy, fiduciary standards, stockholder suits, they all reduce agency costs. Other things that reduce the costs of an agent acting in her behalf instead of mine include things like, come on. Why are you doing this? There we go. Sorry about that. So managerial ownership, we just talked about that. Management compensation, that's why we weight it so heavily with stock options. Monitoring, that's why we do audits. You think we do an audit because the management can't create financial statements? We do it to make sure they're not cheating. That's why we do an audit. That's the only way to align their interests with mine, or to at least monitor their interests, to make sure they're not out of control. Competition in the product and factor markets, that constrains managers. I mean, if managers have big fleets of jets, big offices, huge salaries, that all gets passed down to the price of the goods. And at the end of the day, if the goods are more expensive and fewer people buy them, that constrains management because it makes the company unprofitable. Right? So the central insight of this theory is that we need to figure out a way to align management with shareholders. In the market for corporate control, M&A does that too. Because if I run a company and I don't run it successfully, the stock price ultimately reflects that. And someone will come along, buy the stock, accumulate enough stock, decide that they want to remove me, take the company, take control, purge me, and hopefully run it more effectively and create value for themselves and the shareholders. Okay? That's the theory. There's other examples for why M&A activity exists, everything from solving the agency problem, or really the fact that people want to build big empires because it's an ego thing, to the idea that synergies are the result of mergers and acquisitions. If you watch the press conference, the tape of the press conference when Daimler bought Chrysler, they're asking the German CEO, why did you do this transaction? He says, synergies. And so there's a reporter who, I think it's impressive, the reporter doesn't just stop with that. The reporter says, well, could you tell me what the synergies are, like in dollar terms? German response, they're manifest. Well, could you dial into a particular number? I mean, you've obviously studied this. They're profoundly manifest. A number would help. They're significantly, profoundly manifest. Well, sir, but a number would help me really understand this. German CEO, must be a translation issue. I don't think I understand the question. Let me direct you to my CFO. So they go through the same dialogue with the CFO, right? The CFO finally ends the discussion by saying, well, here we think 2 + 2 = 5. The reporter, does that mean 5 billion euros? $5 billion? No, that's a rhetorical response. I'm not suggesting that's the exact number. Well, what is the number? There must be a translation issue here. I mean, the guy speaks better English than I do. Okay, he's not. He just doesn't want to answer the question because he knows there really isn't a good answer. So whenever I hear the word synergies, my light bulb goes off of BS. BS, the BS meter, because there isn't generally the synergy thing. Most of the times it doesn't work out really. I mean, if you think there were synergies between Daimler and Chrysler, I think we've proven that wrong, right? Because they couldn't get rid of Chrysler fast enough. And they're like, the supposed price was $7 billion plus. No. The Germans assumed a bunch of liabilities. Okay? So at the end of the day, the real price for Chrysler was like $500 million. It's like, take the dog. We just want to give you this dog. We'll assume stuff just to make it go away. So, and the guys who bought it aren't stupid. I assume they know what they're doing. I assume they're going to make money owning it, but it is interesting because Daimler decided, see you later. Okay, most of these mergers end in failure. In fact, there's a great Business Week article in 2002 which looked at the mergers that had taken place up to that time for the last 10 years, and it found that 67% of the time, 2 plus 2 was 3.9. In other words, I took two companies and merged them, and the value of the combined companies actually went down. Now, there's, I think, 3 reasons for that. One good example of that, by the way, is Quaker Oats. They bought Snapple for $1.7 billion. They operated it for 2 years and lost $2 billion, and then they sold it back to the same seller for $300 million. $3.4 billion gone in 2 years, operating a juice company. Pretty impressive, all right? Now, why does this happen? I think there's 3 reasons. One is bad luck, and let's face it, life is luck on some level. Second is poor management. And when I think of poor management, I'm really talking about poor post-acquisition integration. In other words, I acquire a company, and I try to jam a round peg in a square hole, and it doesn't work. There's a great story about Louis Gerstner. He becomes CEO of IBM. And they had just done their first software company acquisition. And he was taking a tour of the software facility of the people who write the code. Okay? And people who write software code, as a very general comment, are a bit odd. Okay? Or at least they can be a bit odd. So he's taking the tour. IBM's a pretty staid place, right? White shirt, red tie, blue suit. These people, suits, no suits. Torn blue jeans, no shoes. Dogs running through the office. Opens the refrigerator door in the lunchroom. Jell-O shots. Walks into some guy who's sleeping on his desk. Smoke drifting through the corridor. Not tobacco. All right? At the end of this whole tour, the guy who's in charge of the integration leaves with Gerstner and says, "Oh, these people are lunatics. I will whip them into shape. I will make them into IBMers." And Gerstner says, no. They write good code. They make money writing code. By definition, they're nuts. Do not screw with them, okay? Because you will make them leave, and we will have bought nothing. That's really an amazing insight, because if you think about it, what we all do, any of us can practice law as long as we have the internet and a laptop, right? We are in many ways masters of our own destiny. The average person, sadly, is not. Knowledge workers have that ability. We are masters of our own destiny, really. If I fly a 747 for Northwest Airlines, am I the master of my own destiny? Do I need them more than they need me, or vice versa? So Northwest mechanics are striking. This is about 1.5 years ago. I'm at the airport, right? I've got time to kill. I don't know, the flights are delayed, of course. So I start talking to the mechanics. I'm like, there's 3 of them there. What are you doing? We're striking. I'm like, no, I'm with you on that. That I see. But I'm like, what's the overall objective here? Higher wages. Like, that's a noble goal too. I'm with you on that one. Do you think you'll succeed? Oh, yeah. Like, okay, let's just think about this for a minute. What do you do? And one guy's like, I fix 757s. I'm like, okay, so do you need a 757 to do your job? Yes. Now let me ask you this. Do you think there are other people who can fix 757s? Yes. So let's go back and, do you need the 757 or do they need you more? It's like, what do you mean? I go, well, isn't it true that I could find other people to fix 757s? Yeah. But you couldn't do your job without a 757. Yeah. So who needs who more? Just so I'm clear. It's like, well, that might mean that they need me less than I need them. Like, uh-oh. that might mean that, right? And that means you're kind of in trouble. Because at the end of the day, if I put parts on a car, I need GM more than they need me. You see, that's the problem with people in that position. It's sad. I mean, I'm not saying it's a good thing. I'm just telling you it's kind of a bummer. But it's the reality. That if I fly planes for a living, I ain't going to go compete with Northwest Airlines by buying my own 747. Not going to happen. So they have a lot more leverage. But when I'm a knowledge worker who really at the end of the day relies on this, I don't need them as much. So Gerstner's insight was he recognizes. Now, let me just talk a little bit about why companies' acquisitions fail. The single most persuasive reason, I think, is companies overpay, and there's a lot of data to suggest that. And all I want you to understand as we depart for the day, a couple minutes here, is how are companies accurately valued? How do you value a company? And I've given you an analysis on 264, 65, 66, and 67. And all I want you to do is look at those examples. And I gave you the overview on 263 of how to do it. I don't expect anyone to ever do this. But what I want you to understand is the analysis or the insights that go behind this. So if I look at page 264, here are the two key numbers to focus on, 264. About halfway down, it says present value at 12.5%. See that number? Present value at 12.5. And then under that, it says assumptions, and it says 10% growth for 2 years, then 2% per annum. See that number too? And then go to the bottom, $15 million. That's what the company's worth, $15 million. Okay, now flip to 265. Now the same company is present value 12.5, but now the growth rate on 265 is 10% forever, not 10 and 2. And now what's the company worth? $83 million. Now go to the next page, 266. Present value now of 8%. We're more certain, not less, that the company will do these numbers. Less risk. We're saying this company is almost as certain as the US government. That's aggressive. Okay. 10% growth in perpetuity. Now the company's worth $133 million. Last page, 267. Present value of 20%. It's 4 times riskier than the US government, 4 times more uncertain. 10% growth forever, company's worth $14 million. This would happen in 2000. People's expectations about growth rates and certainty change about the internet. And when it changed, stock prices got destroyed. Okay? And it was sort of a group epiphany. I mean, and that's what happens. And so people sometimes say, what is my company worth? I kind of am going to say something that's sort of flippant. What do you want it to be worth? Because it all comes down to what your growth rate is and what your expected and anticipated WACC is. And I can tell you your company's worth $1, I can get it to be worth $1 billion with a spreadsheet. Either way. All right? Now, you should question my assumptions. So in a divorce proceeding where one spouse is saying, my business is worth $10 million, and you represent the other spouse, and you're saying, no, the business is actually worth $30 million, I guarantee you they're going to do this kind of analysis, and the whole key of the analysis is going to come down to what the growth rate is and what the discount rate is. Discount rate, same word for WACC, weighted average cost of capital, because those are the key drivers of value. Hopefully you enjoyed today, learned a little bit today. Johnny Carson once said, people pay more to be entertained than educated, right? So hopefully it was a little bit entertaining, a little bit of education at the same time. If you found any of this interesting and want to learn more, A, you're free to call me or talk to me or email me. Or B, I'd recommend the books on page 283. I didn't write any of the books. I don't care if you get them, buy them. I don't get a commission, all right? I just think they're good books, especially the first one. The first one, there's a new edition out this year called Business, the Ultimate Resource, a great book. If I was going to give a student a great book that was graduating from MBA school or law school, I'd give them this book. It isn't cheap. It's like $100+ bucks. It is the single best book I've ever seen on business because he goes through every issue in a page or two. It's an edited book. He's not the author of all this. But he finds experts on all these issues like financial statement analysis and corporate finance and goes through and explains them in great detail, but in an accessible way. So I recommend that book to you if you're interested in any of the stuff or you want a reference source. Thanks again to everyone. I hope you all enjoy the greatest professional success and personal happiness. And thanks for having me here today.